Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Lionshare Bookkeeping believes the key to generating wealth is understanding where it comes from and where it needs to go. They provide bookkeeping and financial coaching exclusively to real estate investors, focusing on cash flow, strategy, and action. Go to lionshare.bookkeeping.com/apartments to connect with them now. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Jacob Vanderslice. And Jacob has some amazing experience in just in real estate in general, but in commercial real estate, he's launched a couple of funds now. They have over $195 million in real estate assets. Our focus today, really in this conversation, is mostly about their self-storage fund. Why they are in self-storage and why they're doing a fund. Some of the pros and cons of a fund, even some of the structure behind their fund, and what they learned from their first fund to doing the next fund. But an amazing guest. You're going to learn a lot, no doubt about it. I enjoyed this show. He talked about creating the self-storage fund, to scale your portfolio, how it's helped them to scale, even just the self-storage industry and during this economy of change, things that are happening right now. But I learned a lot. I learned a lot about funds and how they've done it, and I know that you will too. Jacob, welcome to the show. You have an amazing background. Just in commercial real estate, you're a perfect guest. And so I'm looking forward to hearing about your just experience, where you all are at right now in your commercial real estate business. But I want to go back just a little bit. Tell us, any skill sets or anything you learned, anything, maybe a previous job, anything you want to share that helped you to move, into this space, or have you been in it forever?
Whitney, first of all, thanks for having us on today. Very gracious of you. We love the show. Excited to be here. I would say most of our expertise has been making mistakes and not so much from the wins. We've been investing full-time in real estate for 15 years. We got started doing a lot of single-family residential, like a lot of us kind of got started doing. Did a joint venture with institutional capital back in 13 and 14 on a large rental portfolio. Got into commercial real estate in 13 and 14 as well, doing adaptive reuse retail. And those have been some of the more fun projects we've done. Unfortunately, they're not very scalable, but basically taking an old warehouse, beautiful building, brick timber construction, converting it to multi-tenant retail, leasing it out, then holding it for cash flow or selling it. And then we got into self-storage in 2015, and we like the asset class because it's been really historically defensible with recessions and downturns. It's scalable, it's repeatable, it's predictable. And we grew the platform from there. And now we own 30 self-storage facilities in 9 different markets, mainly in the Midwest and Southeast. And we're just real estate entrepreneurs at heart. And self-storage has been good to us.
Nice. Well, let's dive in there a little bit. With your just vast experience in this industry, you moved. I know you mentioned even starting with like a JV, single family portfolio, some different things like that, moving up to different types of commercial real estate. Maybe before we dive into a few specific things about like self storage, why have you landed on self storage now? Or focusing on that instead of other asset classes?
Well, to begin to answer that question, one of the many mistakes we've made over the years in real estate, both in residential and commercial, is being too transactional. And the enticement of selling quickly for a good multiple is certainly there. The problem when you sell too quickly is you've got a tax problem, first of all. You've got a downtime problem on your cash, and then you've got the risk of a new investment to redeploy your equity into. So we've shifted our focus more so in the last 3 or 4 years to being long-term cash flow investors. And with cash flow comes appreciation and wealth creation. And we found self-storage to be a great vehicle for that. We like the granularity of the revenue streams within self-storage. We're relying on thousands of people to pay us $50 to $200 a month. For example, we have a couple of retail tenants here in Denver, and they're all in monthly payments between base rent and CAM might be up to $20,000, and they're going to pay or they're not going to pay. If they don't pay, it's going to take a year to re-tenant the space, and it's going to cost a lot of money for tenant improvement allowance and capital improvement costs. And self-storage doesn't have that. And the chances you're going to have $20,000 worth of tenants blow out at the same time is very low. So we like that aspect of it. And mainly we're just focused on cash flow and predictable, durable revenue streams. And that's been an asset class that we found creates that.
I appreciate you providing that, just the level of detail there around just the mistakes of being too transactional. And I think earlier on in this business, when many folks get in, I mean, you're thinking about that transaction, right? Often that's where you're making money early in the business, or at least, it seems that way to get started. But I love the thought of, that long-term cash flow, and thinking through that, really, what does that do for not only your wealth creation, but all of your investors as well? I know recently we've had a big focus internally too of structuring deals in a way where we can hold them much longer, right? We've had many investors reach out and say, "Hey, Whitney, instead of selling this in 5 years, what if we just held it, right? Why don't we just hold this, long term?" And so, and not knowing obviously what taxes are going to look like 5 years from now, or 1031 exchange, and we not knowing where those things are going. We want some options, right? We want some options, and it makes a ton of sense to me. And so, let's dive in there a little bit though, as far as self-storage. Now, were you all doing single asset funds at one time, and then you moved to a larger fund structure? Tell me about that thought process and transition a little bit.
Yeah, we've historically done single asset syndications over the years, both within self-storage and outside of self-storage. And we launched our first self-storage fund in the middle of 19, relatively small fund, only 10 million in equity, 30 million in total costs. We closed that fund out in August of 20. We launched our most recent fund in January. That's a $30 million capital raise. We're about 17 million of the way through that. End of this month, which is June, we'll be at 50 million in total debt and equity deployed. And we still do single asset syndications outside of our fund. But the reason we like the fund structure a little more is really twofold. First of all, we like the geographic diversification that a multi-property strategy offers versus a single asset strategy. Inevitably, in a 10 property portfolio, 2 deals might be behind forecast, 6 are on forecast, and 2 are ahead, and they kind of balance each other out. And we also like the geographic diversification. So you've got cash flow diversification and geographic diversification, and investors and us are participating in a wider asset base. And if one deal really falters or gets behind, the other deals kind of prop it up. That's why we like the fund structure.
Yes, no doubt. I mean, everything you just said, I'm like, okay, it makes so much sense, right? And what about, the transition for, say, your investor base? Often, a lot of times, investors say, well, I don't know what kind of deals you're going to be buying. Or, I hear that pushback from a lot of people that are trying to start their first fund. They're worried about, investors, instead of having that single asset syndication where they see the deal, they know the market, they know the business plan, all those things, they can do a little more research. But now, hey, I'm just trusting the operator more than ever, right? And I say you're trusting the operator anyway, even if it's a single, asset syndication. But how do you combat that? How did you get the first fund rolling? And how did you just express that trust with your investors?
The point you made is exactly correct. It is easier to educate and make an investor feel comfortable on a specific asset. They can drive by, it's a specific location, they can see pictures of the property. It's tougher to pitch investors on a strategy. Granted, our strategy has a box. We're only buying self-storage. We're only buying certain types of self-storage facilities. Our first fund, we've had investors who have been with us for over 10 years. And lots of folks are always good for 200 grand in whatever deal that we're doing. And they kind of help seed it and get it off the ground. And then once you start making acquisitions and you can report on some key metrics like cash flow, occupancy growth, revenue growth, it kind of starts to snowball. And it's tougher to launch a fund, whether it's your first fund or your fifth fund, without any assets in it yet. That's a bit tougher to get that first equity in. But once you're halfway through, people can see historic performance. They can understand what you've acquired so far. They can make sense of the strategy. And given that they can understand the deals that you've bought, it's less of a feeling of kind of being a blind pool because they understand. So yeah, just basically seed capital, a couple deals, some historic performance. Granted, it wasn't very long, a matter of months or quarters, and then it just kind of snowballed from there.
How do you see, or do you track, repeat investors in a fund versus, obviously numerous single syndications? Some people, or we've talked about doing a fund. You think about when an investor may put 100,000 in every deal you do, right? A single asset syndications.
Yep.
Then you do a fund and there's a psychology behind it, right? Well, I've already put 100,000 in that fund, right? But you may have 5 deals in that fund, where they may have put 500,000, out if you did single asset syndications as opposed to one fund. How have you, I guess, reached out to investors to encourage them to continue to investing in this fund? Obviously it's a lot bigger than a normal, just one asset.
Yeah. I mean, the first rule of raising capital is you need to be known, liked, and trusted. That's very important. And investors often, a lot of people say this, and I totally agree with it. If someone puts $100,000 into a fund that maybe has a 2-year capital deployment period, and that person is getting distributions, they're getting crisp communication, the sponsor is available for any questions they might want to ask, 8 out of 10 times that investor is going to put additional equity in. Some folks will get one quarterly distribution, then double down. So I would say most of our investors are repeat, and the new ones that have come in, it's very likely they'll put in additional equity as time goes by.
Nice. So it's a continual communication, right? Of the fund, how you're moving forward, all those things. No doubt about it.
And honest and transparent communication. We have a quarterly report that we kick out, and it covers pretty much any key metric that someone would want to know at the facility level as well as the fund level. And we report more on the bad than we do on the good. The good stuff people don't really want to hear about much. We just kind of put a green box and say we're ahead of forecast or on forecast. And if we're behind forecast, say on revenue growth or occupancy growth or expense, maybe our OpEx was 10% higher than we underwrote in a given quarter. We talk about why that happened, what we're doing to correct it. And folks like to see that. And if you're communicating all of the metrics and all of the good and the bad, that helps establish trust and credibility and transparency with our capital base.
How has the fund helped you to scale?
First of all, one of the parts we like about the fund, in addition to the things I mentioned earlier, is it's one set of documents. So you're not creating a new LLC, you're not creating a new PPM, offering documents every time you buy a deal. And it's one set of subscription documents and one set of terms. So investors come in under the same terms with the same expectations. And that really has been a great opportunity for us to be more efficient with our capital raising and our strategy, and spend less time on the administrative side and more time on the real estate side and the execution side. So even though funds are a strategy versus a single asset, I think they're a little bit easier to manage and especially easier to capitalize once you've got some track record behind you. Yeah.
What about, how has your, thought process behind, say, the structure of the fund changed after you've done one or two now? I'm not sure how many you've done, but after even one, though, I think you learn a lot, right? But the structure of a fund, any lessons learned there that you could share as far as maybe things, we didn't realize this on the first fund, but we're doing this on the next one or have done it.
So our first fund was a fairly simplistic capital structure. We had an 8% preferred return, then return of capital, then 70-30 with no muted upside, no hurdles beyond that. And we found in our prior fund that our investors really enjoyed dividend yield and distributable cash flow. As you know, and a lot of your listeners probably know, preferred return accumulates whether it's paid or not. And eventually, hopefully, preferred return gets paid as long as the syndication or fund generates enough net income. But we strive to be able to pay preferred return quarterly and pay it current so it doesn't accumulate along the way. Fund one was 8 pref 70-30, and our most recent fund 2, the only difference in the capital structure was we have different share classes based on invested capital. So over $1 million invested is 80-20. Over 500K invested is 75-25, and under 500 is 70-30 with a 100K minimum. And we layered that in to incentivize folks basically to write bigger checks and get additional better economics. We also gave all of our existing investors in any of our deals an automatic bump to the next class of shares, regardless of their invested capital. So if an investor came in for 100K who was in a prior fund or syndication, that person was automatically increased to the next class of shares, which is 75-25. So that's really the only difference. On our next fund, which we're going to launch next year, we're considering doing a preferred equity component. All of our equity right now is common equity. And preferred equity, as you, I'm sure you know, and your listeners, is kind of junior to the debt and senior to the common equity. typically gets a lower yield, but it's a safer piece of the capital stack. So that's one additional component we might layer in on the next round. We've had a lot of folks ask about it. We haven't been able to do that because it's not within our documents. So that's certainly in consideration.
No, I appreciate you sharing just that level of detail. It's incredible. And the listener, I mean, if you were thinking about a fund, you need to be taking all those things to heart and thinking about what Jacob's saying there from great experience, no doubt about it. What about, just from the investor's standpoint, investing in self-storage during just this economy of change?
Well, I'd like to say I'd rather be lucky than good. And we were lucky we were in self-storage in 2020 and not more scaled up in our retail line of business, because we got through it. A lot of our tenants suffered. Thankfully, we kept everybody except for one person. But self-storage did great during the pandemic, and it continues to. And the REITs, our portfolio at the end of Q1 had record occupancy growth from Q1 of 2020 to this year. And self-storage really benefits from disruption events like a pandemic or a recession, whatever might happen, because people get displaced. They need places to keep their stuff. It's out of sight, out of mind. It hits their credit card every month. And it's been good to us in the downturn of 2020. And obviously, we're all coming out of it right now. Things are looking much better. And other operators are reporting the same results. We've had great occupancy growth and great revenue growth. So we're fortunate to be in an asset class that made it through, as opposed to maybe hospitality or to a degree office and retail. Self-storage hung in there pretty well.
Yeah, no, that's great. And you briefly mentioned like REITs. Well, how does something like this compete, with a REIT?
So deal flow has been one of our big challenges in 2021. And a lot of operators that are in real estate who have capital allocations, who are maybe focused on hospitality, retail, other asset classes that got a little more beat up, still have money to put out. And now they're in the self-storage business. So if it's a widely marketed deal by a professional broker, there's a call for offers, we can almost never compete, because we're trying to blend current yield with capital appreciation at the same time. So we want to distribute cash flow, but we also want upside. A lot of folks out there are only looking for yield. They want to clip an 8 during the life of the deal, then sell it for a break even, and that's their requirement. Others don't care about cash flow. They're banking on appreciation and cap rate compression. And we're kind of trying to achieve both. So deal flow has been a challenge. If it's a Class A multi-story climate controlled deal in a primary market, we can't compete. We can't come close to the REITs. Public storage, Extra Space, CubeSmart, they're very aggressive right now. Most of our deals are in secondary and tertiary markets, which are very overused words these days because we're all doing deals in those markets. But we found those markets are a good blend of capital preservation, yield, and appreciation. We've also found that the REITs aren't as competitive there. They're not as active in those markets. Places like Pensacola, Florida, suburban Charlotte, suburban Memphis, Tennessee, Columbus, Ohio, Detroit, Grand Rapids, markets like that, which we're already in, we're not seeing as much REIT competition in. So we try to fly below their radar. And if we're going toe to toe with them, we can't get the deal.
No, it's good to just know that too, right? Like who you're competing with, and help think through what market you're in, what markets they're in, maybe. But that's interesting. And maybe you could provide a little more light there too on just like picking the right location, right? How are you picking those locations, and for the fund or not?
Yeah, self-storage is very local supply sensitive. So we track supply ratios in the 1, 3, and 5 mile trade radius. Nationally, there's about 7 square feet per capita self-storage across the U.S. Once you're getting into submarkets that are over 10 or 12, you start to see a decline in occupancy and revenues. And then under 7, under 5, and less, you start to see much more buoyant occupancies and more buoyant revenues and in-place rates. So we try to focus in markets with balanced supply ratios, and markets with a subjective and objective low risk of the introduction of new supply. That might be because zoning is not receptive to self-storage. The city's not receptive to self-storage. We also try to buy deals at or below replacement costs. So if a competitor does build a facility nearby, their asking rents need to be incrementally higher than our asking rents to achieve the same yield on cost. But supply is really one of the big risks right now in self-storage. And I think supply peaked for the most part in Q1 of 2020. There was a lot of new construction in 2019. So number one is supply. And then beyond that, just good nuts and bolts demographics and real estate. You don't want an oppressive tax regime. You don't want to be in a municipality or a state that has a declining population. You want density. You want rooftops, good land, good locations, just like any other real estate deal. Applies to self-storage.
And one thing I meant to ask you earlier about funds, and you were talking about the challenge of deal flow right now. I mean, I think that's almost anyone in this business at the moment, right? Or just the challenge of finding deals and of good deals, right? You want something you can move forward on. But what about, in the, operating a fund specifically, you raise all the money, you have this money, any risk of not being able to deploy it, right now with just the challenge of not having good deals?
Yeah. The day that our capital raising and our deal flow is in sync is probably going to be never. It's always too much of one and not enough of the other. And then overnight, the pendulum shifts. We get a deal under contract. We got to hit the gas on capital raising. So we try to raise our capital kind of incrementally as we make acquisitions. What we're not doing is going out and raising $30 million on January 1st and having it sit in the bank and then hoping to get it deployed. So we try to balance our capital calls with our purchases. That's tough to do. It's tough to do. We've got investors who are about to sign documents, investors who have signed documents, but maybe they can't fund on time, and kind of everywhere in between. And figuring out that cadence is certainly a challenge.
Yeah, no doubt about it. Well, I just think you just shine some more light there on, hey, we don't raise it all up front. We're not just opening it completely day one, right? And I think that's very smart. So how do you communicate that with investors to say, hey, it's closed temporarily, or it's going to open, we're going to open it back up at a specific point? How do you do that?
Well, one of the main reasons we don't get it capitalized out of the gates is we want to turn preferred return on when an investor funds or shortly thereafter. And obviously, if somebody funds the entire capital stack on day one, there's no income to pay preferred return. It accumulates, and that's not a good thing for them or for the fund. So we'll typically say, okay, we're raising $6 million in equity for our next acquisition. Now that capital stack is full, but our next acquisition thereafter is 35, 40 days later. We've got another $4 million in room. And so that's how we communicate kind of where folks are coming in and when.
Okay. Wow. So, such great information about operating fund, Jacob. Very grateful for your transparency and helping us and the listeners. What about just preparing for a downturn? How do you prepare for a downturn when operating a fund like this in the current environment and with self-storage?
Well, downturns are always at the top of our minds. I was in real estate during the financial crisis. I got beat up pretty badly. I learned so much. I would do it again. And back in 2015, we thought we were overdue for a correction, right? A lot of new construction, multifamily was coming out of the ground in Denver. Apartments were arguably getting oversupplied. And we were wrong. That correction was not coming anytime soon. The pandemic hit, and we thought that was going to be a massive correction. And with the exception of a few asset classes, it was the opposite, right? Residential real estate's on fire. There's so much equity out there chasing cash flow and yield. So in terms of preparing for the next downturn, we've done a fair amount of development in self-storage and residential and a number of other asset classes. Development is great, but it's risky. And you're forecasting out revenues 2 years from now. You've got hard cost risk, you've got revenue risk. So within our fund structures, we're focused on only buying existing self-storage facilities with decent in-place cash flow that we can add value to with operational efficiencies over time, just growing NOI, controlling expenses, growing revenue. And our main line of defense for a correction is that we're buying these things with existing income. And if we screw up our pro forma, we don't grow NOI, we don't grow revenue like we think we can, it's still a rational dividend yield and still a good debt service coverage ratio to make our lenders happy. If there's a massive boogeyman event, which I'm not sure how much worse it could get than 2020, we think we're pretty well defended against that. And we're also implementing fairly conservative leverage. We're levering most of our properties at 65% of cost. And we're getting some very attractive debt terms these days. Our next acquisition is going to be a fixed rate at 3.75% for 10 years. And that's full term interest only payments. So the loan never amortizes. And amortization is good, but you can't distribute amortization. And if you're having a cash flow problem, you still have to make that payment. You're paying down principal, but it's substantially higher than an interest only payment. So we're very focused on dividend yield and distributable cash flow. So we're buying occupied properties and we're financing them with conservative leverage. that we think is very attractive and probably not leverage we're going to see for a while.
What about any predictions that you may have for the real estate market or industry over the next 6 to 12 months?
I'm not a good predictor because every time I predict, I'm wrong. I think that the deal flow is going to remain very challenging. We're obviously entering or already in an inflationary environment. And I think that controlling hard cash flowing assets with a fixed cost of capital on the debt side is a great defense against inflation, especially in self-storage. Obviously, I'm biased, but all of our leases are month to month. So if inflation kicks up even more, our rents are going to go up and our debt service is going to stay the same. So we're excited about that. But I think there's a flood of equity out there. And to a degree, not desperation, but a majorly high desire for investors to rotate out of the publicly traded equities markets, which are very much high right now, into cash flowing hard assets. So I see the competition remaining fierce for the foreseeable future.
All right. Well, taking a pivot just a little bit on a few final questions, Jacob, any daily habits that you have or disciplined about that have helped you achieve success?
Well, my discipline has diminished since we've had our kids. We've got a 3-year-old and a 21-month-old boys. And
congratulations.
Go home and take care of them. Yeah, thank you. I try to work out, try to get on my road bike as often as I can. Lots of hiking and climbing in the summertime. I hit the golf course as often as I can. But my main work management tool is my calendar. I live and die by my calendar. I block time off if I have a task I have to complete. A lot of our investors and associates are accustomed to scheduling calls with us so that when they call you out of the blue, you can't pick up the phone, you call them back, they can't. So really calendar management has been kind of a critical component to just allocating your time during your day properly. And I see you do the same thing too with scheduling your podcast. So it's a great tool.
Every day of the week. It's just numerous appointments. They are scheduled. Yes, we have to go by just like what you said. You have to live by that calendar. And I like the point you made there.
It's made my mind mushy because if it's not on my calendar, I forget about it. So
yeah.
I'm probably too reliant on it.
Yeah, my assistant knows. Hey, if it's something, even if it just involves me, you better put it on there so nothing else even gets scheduled. During that time. But I like the point you made. That, even investors, like that's an important meeting. We take it very seriously if an investor wants to talk. But like you said, they call, we can't answer. Then we call them, they can't answer. Hey, if it's just scheduled, we can usually make it happen a lot faster. But what about your best source for meeting new investors right now?
So we're doing a couple things. LinkedIn has been a great resource for us. One of our guys in our marketing department does a lot of stuff on LinkedIn. So that's been really positive. We're in a couple different masterminds. We have a number of physician investors, dentist investors, and just networking and really establishing credibility and being educational and demonstrating to investors that we understand our space. We know what we're doing. We're not new in the real estate fund world or the self-storage world. And a lot of word of mouth too, and a lot of referrals. If somebody comes in for 100K, they get a few distributions, they like your communication, they'll tell their friends about it, and it just kind of snowballs from there.
What's the number one thing that's contributed to your success?
Failures. Absolutely failures. Just learning what not to do on deals. No, not so much what to do, but what not to do. And one example is just kind of chasing shiny objects. So I'm absolutely the shiny object guy in my office. I hate using that phrase, but that's the best phrase to use to describe it. We built a house out of shipping containers about 6 or 7 years ago. We lost a lot of money on it. We learned a lot. We bought a couple self-storage deals in our prior fund, and we attempted to completely remotely manage them with no on-site employees. Learn some hard lessons there. You can still do it, but you have to do it differently. So really just making mistakes along the way and applying those mistakes to future deals, and always just having capital preservation and the next downturn at the top of your mind and what your portfolio's positioning looks like when and if that happens. So yeah, we learn from screwing up.
Who is it? I wish I knew who said this, but it's like fail fast, right? You're going to fail. But learn, right? The faster you do it, you're probably going to fail at least partially. Maybe, hopefully it's not too big, but you're going to learn, and then you can move past that. I appreciate just your transparency, because that's all of us, whether we admit it or not, right? And how do you like to give back?
So I did Big Brothers Big Sisters for about 8 years with my little, from when he was 9 to almost 18. A lot of time and effort went into that. It was a great experience. I'm considering getting another little here, but unfortunately I've got my own 2 littles. So maybe when they're a bit older, I'll get back into it. We're also involved with a nonprofit here in Denver called Historic Denver. They do a lot of historic preservation work around town. They prevented some beautiful old buildings from getting torn down and having sterile multifamily and retail built on them. So those are 2 examples right there.
Jacob, I appreciate your time, just your level of transparency and detail that you've provided around operating a fund and self-storage and just the economy right now. Numerous aspects. A great interview. And tell the listeners how they can get in touch with you and learn more about you.
So a couple different ways. LinkedIn is one, Jacob Vanderslice. Hit me on there. You can email me at jacob@vanwestpartners.com or go to our website, vanwestpartners.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.